CNBC-TV18, embarking on a quarter century of excellence.
Welcome back. You're still tuned into Midcap Radar on, still tuned to CNBC-TV18, and it is a special day for us. But we'll do one thing. We'll get you all the special voices and the big voices that we have been speaking today. In fact, my colleague Latha spoke to KV Kamath, who's the chairman of National Bank for Financing, Infrastructure and Development, and began by asking him how he sees the economy going forward and his views on RBI's risk-weighted asset norms as well. Listen into that conversation.
Actually, I was always expecting to be around 7.5%. So it was honestly no surprise. Okay. Because that was our potential, and I'm happy that the potential was realized. And it has not happened by accident. There has been, I would say, a momentum that was building up and leading to this growth. The momentum is on several pillars. The momentum, of course, is there is a demand drive in the economy that's happening. Demand happens only when there's money in the people's hand, and there is aspiration. And you also need the people who meet that demand to have the capacity to meet that demand and to invest. And of course, for them to borrow if necessary. I think all these have fallen in place. And if you look at from the time of COVID, take a very quick snapshot. Twin balance sheets were cleaned up. So there was money in the hands of manufacturing companies, the bankers. Then clearly there has been growth in incomes of people. And aspirations were always there. So it is the right time that this happened. And I would think that this is just the start of momentum, because you will now see the digital economy, the digital super cycle, as I used to call it some time back, start to kick in and overlay. It will be an overlay on that 7.5%. So let's see. Okay. Good news.
Well, I'm glad you touched on that, because I wanted to ask you, the recent Reserve Bank rules putting more risk weights on unsecured loans. Do you think that that might slow down, maybe correctly, but will it slow down lending? Because there was a fear in the Reserve Bank that some of the digital loans at least are being given perhaps without enough data.
I think we need to understand what is the impact of lending. If lending is a merry-go-round, and it is basically washing the debt that was there, I don't think it is good news. And the pace at which things were growing, as a banker, I would think was giving a signal that maybe there's some need for caution. Then came the second issue, where we found that there probably were multiple loans that a borrower was taking. And thirdly, point that he's probably approaching other people for even more loans. It doesn't stop there. And to top it, the fact that look at the NIM margins, NIMs that some of the NBFCs were having. At those NIMs, you need to have a bit of caution. So to me, there were cautionary signs, and Reserve Bank has done well in tightening the requirements.
But for the fintech sector as a whole, do you think this comes as a nasty jar?
No, it's not a nasty jar. It's a wake-up call. Okay. Because if you are doing certain things which clearly are not good systemically and for yourself, then the regulator clearly has to give a shout-out to you. And that's what has happened. To me, it's a wake-up call.
Okay. How do you see the pace of economic growth? We did 7.6%, yes. But now there will be a couple of things. First of all, you will have consumption. As it is in that 7.6, consumption was not a very big piece. The bigger piece was really investment, and more of that coming from the government. But consumption could get a bit of a weight, a low down because of the higher risk weights. And plus you have, global interest rates also, which will start hurting global growth. So do you think we should be prepared for at least a year of more mellow growth?
So let me address the Indian situation, then global situation we can, because the global situation has been troubling for 3 years, so we have not really been impacted by that. The Indian situation, the first point is that the incremental lending that could have happened with lower risk weights, to me, was actually of no consequence, because it was not adding to growth. It was only recycling. That's my assessment. Somebody has to bear it out. But if the regulator has acted, and I would fully support the moves taken, then it is not adding to growth. So that's point number one. Point number two, in terms of components of growth, infrastructure, yes, and the government probably in our country for certain areas, government is the best party to invest. And now if the government can invest without drawdown from the budget,
Yes.
what better situation can, you cannot be in a better situation. So, for example, if NHI is putting out roads, and now they have what I call a perpetual financing engine through the InvIT structure. They have roads, they get matured, they are seasoned, their cash flow is good, you create an InvIT, and you invest in the next road. So that's the sort of growth that you would want in almost every area of business that is there. Then in manufacturing, there has been this point that investment is not happening, the private sector really investing. I think private sector invests very opportunistically. So if your capacity utilization is at 75% or 80%, and your implementation or lead time these days is 12 months, maximum 18 months, why would you invest in advance? And again, if one looks at and see, you have internal accruals to fund. So you don't see it reflected in bank borrowings, going for investment. I think we are in a good place.
All right, very interesting conversation there with KV Kamath, and we're going to keep bringing you very exciting chats through the day as we celebrate our 25th birthday. But with that, it is curtains down on this edition. Stay tuned. Closing bell comes up next for the final hour of trade.
CNBC TV